People love dividends, and today we're going to look at some of the best dividend-paying ETFs on the market. Whether they are paid monthly, annually, or quarterly, investors often choose to invest in individual companies that pay dividends, as those extra dividend payments can be a great addition to portfolios, offering potentially consistent cash flow and stable income. But building a portfolio of those companies to take advantage of the individual stocks that pay the better yields can be time-intensive, requiring a lot of research and portfolio management, and comes with increased risk, which is where dividend ETFs come in. But what actually is a dividend ETF? Well, instead of buying individual dividend-paying companies, you buy one ETF that consists of hundreds or even thousands of dividend-paying companies. And in doing so, the fund will try and get you the best collected dividend returns from these companies on a consistent basis, whilst also giving you the added diversity, not being focused too narrowly and concentrated on one or only a few stocks. Remember that this is a financial education video and is not to be construed as financial advice, and I'm not recommending any of the investments details here. Please fact check anything that anyone tells you on YouTube, including what I say in this video today. Hopefully this video will help you with your research and deciding if any are right for you in your individual circumstances, but consider seeking advice from a suitably qualified professional if unsure about anything to do with investing. When trying to find the ETF with the best dividend yield, you might look at that yield figure in isolation. But when doing your research, you should take account of the total return that the ETF provides. Companies that pay high dividends might reinvest less in their own growth, leading to potentially lower capital appreciation compared to non-dividend paying stocks. When a company pays a dividend, the value of the stock is potentially affected. You are taking money out of the company to pay to a shareholder and nothing comes for free. So in an ideal world, we would try to pick companies who are paying a reasonable dividend while still providing growth or the potential for it. And as I go through the featured ETFs, I will provide the dividend yield and total return figures. But remember that just because an ETF has provided a certain yield and return previously does not mean it will continue to do so. And past performance figures should only be used as a guide and not as a reliable factor of what might happen in the future. Investing in a dividend ETF can be a cost-effective way that you can obtain a steady stream of income without you having to sell assets, so still potentially obtain some long-term portfolio growth. So let's start off in the UK with the first dividend ETF, which is the iShares UK Dividend UCITS ETF, which is ID'd with the ticker of IUKD. And this ETF passively tracks the FTSE UK Dividend Plus Index. And this consists of the top 50 dividend-paying companies in the FTSE 350. The FTSE 350 is a stock market index that represents the performance of the 350 largest companies listed on a London Stock Exchange. And in this ETF, the top 10 holdings hold significant sway, representing almost 45% of the fund, with just over 30% of companies in the fund being from the financial sector. You'll recognise some big names in the top 10, which has significant bias to the financial industry. So although spread across a range of sectors, the diversity this ETF provides is reduced given that 5 of the top 10 companies are financials and the weighting towards the financial sector as a whole. The OCF, or ongoing charge figure, is a fee for administrating the fund, and they tend to be higher with dividend ETFs when compared with those standard ones such as the Vanguard S&P 500 UCITS ETF. And the fund's OCF, or TER, total expense ratio, is 0.4% in this one. And this is not cheap, but I will mention a cheaper alternative shortly. Its current yield is a good 5.49%, and the fund's total return for 5 years is 29.41%, with impressive performance in the last year of 23.02%. The fund's 3-year standard deviation figure is 14.32%, which is by no means low, with global equity funds potentially offering better long-term returns for a lower overall risk. Standard deviation measures the volatility of a stock's price, with a higher number meaning more volatility, and this being closely associated with the risk of the asset. The risk being that the more volatile the stock, the bigger chance of not getting back what is invested. So what are analysts saying about the prospects for this one in 2025? Deutsche Bank analyst Sanjay Raja mentioned that the government's focus on lifting investment into UK companies, especially through consolidating pension plans, could boost UK listed shares. Other analysts have taken a more bearish view, with concerns about a lack of growth and depressed sentiment in the UK market. Blue Bay Chief Investment Officer Mark Downing comments that the UK is braced for these challenges, which could impact the performance of UK stocks. Overall, while there is optimism about the potential for capital appreciation and income generation, there are also significant concerns about economic challenges that could affect the ETF's performance. Given that the FTSE 100 consists of some great dividend-paying stocks in any case, an alternative to investing in this iShares ETF may be to invest in a straightforward distributing FTSE 100 or 250 fund, such as the Vanguard FTSE 100 UCITS ETF, which comes with a ticker of VUKE. This comes with a much lower OCF of 0.09%, reasonable current yield of 3.5%, better 5-year performance figures of over 40% returns, and a much more diverse sector allocation with less reliance on the financial sector and a lower 3-year standard deviation risk figure of 10.64%. And moving on to the next fund, we're going to stick with the UK and look at an ETF that might appeal to the more environmentally conscious investors amongst you. And that is the L&G Quality Equity Dividends ESG Exclusions UK UCITS ETF with the ticker of LDUK. This ETF passively tracks the FTSE All-Share XIT, XCW, XTC, XREIT Dividend Growth and Quality Index and contains 38 stocks that have positive dividend growth, a relatively higher forward dividend yield and enhanced quality exposure. The fund promotes a range of environmental and social characteristics which are met by tracking the index. And in this one, there's a very heavy weighting to the top 10 companies that represent almost 54%, with even more financial sector bias overall of just over 50%. But it has a lower cost OCF of 0.25%, and its current yield is a decent 4.22%. The fund only started in 2022, so the 5-year figures were provided by the benchmark index itself, on the assumption that the fund would have tracked it accurately had it been in existence over this period. With excellent 5-year performance figures of 51.7%, far outstripping its non-ESG counterpart, the FTSE All-Share Index, which only managed 37.9% over the same period. The fund's actual 1-year performance is also better than the iShares UK Dividend UCITS ETF at 25.84%. And the fund's 3-year standard deviation figure is 13.63%, which is by no means low, but seemingly lower than iShares UK Dividend UCITS ETF. And what are the analysts saying about the prospects for this one in 2025? Well, analysts have a cautious optimistic view about this fund for this year, with markets.ft.com stating that the fund's ESG focus is seen as a positive factor, attracting investors who are looking for sustainable investment options. And Morningstar.com suggests that the ETF's solid dividend yield is appealing to income-focused investors, especially as it includes high-quality stocks with strong fundamentals, which can provide stability and potential for long-term growth. But markets.ft.com states that some analysts are concerned about potential market volatility and economic uncertainties that could impact the performance of this ETF, with Morningstar adding to what's already been said in that the ETF has a significant allocation to the financial services sector, which could be a risk if the sector underperforms. Whilst often having home bias when researching what ETF to invest in, it might be prudent to invest in a global dividend ETF that provides access to the best global dividend-paying companies, whilst providing additional regional diversification. And this next one is one of the most famous, which is Vanguard FTSE All World High Dividend Yield UCITS ETF with a ticker of VHYL. Being a global ETF, this one provides diversity that was maybe lacking a little from the others featured so far, with far less weighting being afforded to the top 10 companies at just over 12%. Financials, which is still the largest sector, takes a lesser 27%, and there is a better overall sector balance in this fund. This ETF passively tracks the FTSE All World High Dividend Yield Index and consists of 2,123 global large and mid-cap companies, including the emerging markets, so including some companies in countries such as China. And there are well-known, reliable paying dividend companies, as you can see in the top 10. The USA has a lower representation than it would normally have under global market cap at 42.5%. Some of the bigger dividend-paying companies are based in countries such as the UK, Japan and Switzerland, who have an increased market share in this fund. And the best dividend-paying companies tend to come from sectors such as financials, industrials and consumer staples, with the technology sector that you would see at the top of a list in a global market cap having less bias when it comes to dividends. Interestingly, there's an accumulation version of this fund with a ticker of VHYG. So if you like the look of this fund, but you just want those dividends to be reinvested automatically, rather than taking those dividends as income, then that version might suit you better, even if it does seem to go against the aims of an ETF which is designed to pay out dividends. It has an OCF or TER of 0.29%, and its current yield is a smaller 2.91%. But the fund has provided a 5-year total return of 50.55% and 17.03% in the last year. The fund's 3-year standard deviation figure is a much lower 9.56%, with figures between 5 to 10% expected for diverse global funds. And what are the analysts saying about the prospects for this one in 2025? Well, again, analysts have a generally positive outlook on this ETF, with Morningstar.com being optimistic about its potential performance due to the diversity it provides to mitigate single market risks. with a strong performance history and annualised return of around 8.71% over the last 10 years. They do, however, recognise that the ETF does still have certain sector concentration and significant exposure to sectors like financial services and energy, which could be a risk if these sectors underperform. Overall, while there are some concerns, the broad diversification and strong historical performance make VHYL an attractive option for many investors. If seeking an alternative to this one, then the Vanguard FTSE UCITS ETF with the ticker of VWRP might suit. This one is not a specialist dividend-paying ETF, but VWRP is a distributed version and therefore pays dividends. Just like many other general equity ETFs, if you select the distributed version, you then get the dividends of the companies in the fund paid directly to you, whereas accumulation versions automatically reinvest them back into the fund for you. So as a distributed version, this could fulfill the objectives of income-seeking investors. Its current dividend yield is smaller at 1.43%, but it has better total returns overall, providing 70.41% over 5 years and a 1-year return of 19.95%. This ETF is also cheaper, with the OCF being 0.22%, and is in line with global market cap, with the USA taking the 61% proportion of the funds. 9 of the top 10 companies are from the USA, and the tech sector, being the largest, provides a fighting chance of good continued growth if past performance is to be repeated. But this one has a reasonable standard deviation of 10.73%, with that global diversity managing volatility and risk. And we are going to visit the USA for the final ETF that we look at, which is the Invesco S&P 500 High Dividend Low Volatility UCITS ETF with a ticker of HDLG. This one tracks the S&P 500 Low Volatility High Dividend Index of the 50 least volatile high dividend yielding stocks in the S&P 500. The top 10 companies account for about 27% of the index, with utilities and consumer staples being the biggest sectors. Hence the different companies you can see listed, with the tech sector only accounting for about 3%. It has an OCF TER of 0.3%, and its current yield is 3.39%, with 5-year performance figures of 40.99%, and the fund's 1-year performance is 20.7%. The fund's 3-year standard deviation figure is higher at 16.41%, which is to be expected, as you have lost that regional diversity. And what are analysts saying about this last fund? Well, ETF.com reports a general positive outlook for this fund for 2025, citing potential stability and income from 50 least volatile high dividend yielding stocks in the S&P 500, and diversification from offering broad exposure to large cap US stocks as important factors for success in 2025. But in general terms, it also warns about market volatility that could impact performance along with sector concentration, which could be a risk if those sectors underperform. So this might be one to choose if you want to invest in a dividend ETF because you feel more comfortable with the USA. So there are 4 dividend ETFs and some distributing alternatives for you to look at when you do your research. If you are retired, close to it, or just want a regular income stream, then investing in a dividend ETF might form part of your strategy. But if your long-term aim is to grow money as fast as possible, for retirement for instance, then there might be more efficient ways of doing this other than investing in dividends. With dividend ETFs, the OCF or TER might be more expensive than those in a standard ETF, and you could be exposed to the additional risk of companies not paying dividends during market downturns, impacting the income you receive in addition to the overall performance of the fund you're invested in. Like everything in investing, you firstly need to understand your objectives and then take time to research your options before you make that final decision. Thanks very much for watching.